Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to celebrate the fact that the Fed is done hiking rates and, in fact, is even talking about cutting rates in 2024. Logan, welcome to the podcast. I can't even believe this day. It's crazy.
It was like millions of bearish housing crash people all of a sudden threw up at the same time, and we're talking about, okay, we just got off the Fed presser right now. And I think for those that have followed us, especially the last few months, the Fed made a really bad mistake being very hawkish when they didn't need to be. The 10-year yield never should have really gone above 4.25% to 5%. They started panicking like, oh my God, what's happening? And I think after that terrible experience for them, and after some of the more recent inflation data today, I know some of the Fed members kind of changed their tune after they saw the producer price index inflation today. That's it. Sarah Wheeler, it is over. We can now talk about the rate cut cycle and how the entire marketplace is going to shift now from a hiking cycle to neutral to how many cuts we're going to get, what the cuts are going to look like, what's the 10-year yield. The whole thing has now turned, right? And it all goes back to the history of economics. Have always taught us that when the market believes the Fed is done, the next big move is bond yields rally. It means 10-year yield goes lower. And what happens when the 10-year yield goes lower, Sarah Wheeler? What happens?
Mortgage rates, it's a slow dance with mortgage rates. They're going to go down.
It is the slow dance right now. And then mortgage rates follow. And all this talk about, well, the deficit spending, Bank of Japan, issuance, everything. Oh, it is one of the more historically beautiful kicking that has just occurred with the bond market rallying like it is, because it did basically what it usually does when the market believes the Fed is done. And the honest truth is, in some ways, it was a blessing in disguise, even though I think it was detrimental that we wasted 3 months with the 10-year yield getting up to 5% and 8% mortgage. That the Fed learned a lesson that there is a point of being too hawkish. I know Jerome Powell talked about that today, that, they're very aware of, keeping rates higher too long or staying hawkish. And I really do think that move in the 10-year yield spooked all of them. And they really did. They had no reason to do it. We should already be so much lower in the 10-year yield today. We did not even need to even deal with that process. But it's a blessing in disguise, because I think that was the wake-up call that, okay, maybe we're over pushing it. Let's not do it. Let's talk about the dual mandate. I mean, literally everything we wanted, right? Let's talk about rate cuts. How many? Just 75. That's fine. Whatever happens, the economy, if it gets weaker, then you're going to get more rate cuts. The 10-year yield is going to go down. But, that other drama is over with, right? That other drama is over with.
And that's been an 18-month drama. I mean, when they started hiking rates, in March 2022?
It did. The irony of everything, Sarah, is that literally like 1 year ago, we were here talking about who spiked the Fed's eggnog. That was our whole theme. Like, what happened? Like, they already raised rates so much so fast, and they had a talking point that I always like referred people to, that Jerome Powell talked about. We want, the Fed funds rate kind of mirroring 3, 6, 12-month core PCE. Well, 6-month core PCEs at 2%, right? They're already there. So they are very restrictive. So I think this conversation of real yields is very new to a lot of people. And we just got in a very restrictive stance because the growth rate of inflation fell. If inflation was running at 7-8%, we're not having this discussion, but it's not. It's heading lower, and there's some disinflation factors that are keeping some of the data line artificially higher than what it is. So it could not have been any better than what we saw today. The dot plots are talking about rate cuts, and they're very good. They're going to be very mindful now of jobless claims data, which means the bond market is going to be very mindful of jobless claims data as well. So it's good Grinch. He decided that, hey, we want to have friends, and we want Christmas to be happy, and we want kids to get gifts. And I think the 10-year yield let me see, it's 4.4. It got roughly down to 4%. So it's just we're in a better spot going into 2024 now than what we were a year ago. I'm thinking, who spiked the egg dog, and now a year later it's the happy Grinch. And a lot of the criticism we've been doing here over the last 2 months, especially the last weeks, we need to start talking about rate cuts now. Fed policy is too restrictive. It's way too restrictive for housing. So we could not have asked for a better day than this. The reign of terror is over. That whole super fast rate hike cycle, there's no more rate hikes, and now we're talking about cuts. How many cuts? And then really what matters, what the 10-year yield. Bond traders are going to know this now. So the dynamic shifts have happened, and really it started when the bond market realized that the Fed rate hike cycle is done, and they did pretty much what they do in every single economic cycle. They send lowers, and I think a lot of people remember when the 10-year yield was at 5%. We're like, my God, the things are so crazy right now. This is usually what happens at a top of the bond market. We stay up until 1:00 in the morning watching the 10-year yield overnight trade. Everybody's wild, everything's crazy. And it felt so good because I just know so many of my housing crash friends and recession, and people want people to lose jobs, and all the idiots out there. There's a sickness in their stomach right now, and they have to wake up living in the United States of America and thinking, oh my God, this whole thing isn't going to collapse. What am I going to do? You're going to be the same idiot like you've always been. Nothing's going to change. One trick pony is going to be one trick pony until the last day, and that's it. So very good, happy day, right? There's still a lot of work to do. We still don't want a recession. There's so much, but at least we got this over with.
At least we got this over with. I do think it's funny that just very recently you wrote, maybe it was yesterday or the day before, you were talking about which Jerome Powell will show up. Will he be the Grinch for 97% of the movie where he's just terrible, or will he be the last 3% Grinch where where his heart grows and he realizes what he should do? And we were really pulling for the good Grinch to come out.
I was tweeting out videos of doves, right? We always go hawks versus doves, and everything that I saw right off the bat, doves. So, yeah, early Christmas present. The good Grinch is here. So now we just, take it. Of course, like everything else, we take data one day at a time, but we have a different structure to work with now. It's over.
It's over. Okay, so let's talk about rate cuts, right? You know me, I'm always about the rates. I want to get right to it. So when we talk about rate cuts, did he say 3 rate cuts he thought were?
This is where the Fed, this is the dot plots, which I think they should just destroy the dot plots anyway. But this is the first time that they're talking about rate cuts, right? So we've talked about this before, that they should be doing this now. Like, what are we doing? Like, I know it's hard to like tell people that they're very restrictive, but with the growth rate of inflation falling, they're really restrictive. They needed to talk about rate cuts. So all they did is basically the standard, maybe 3 rate cuts, 75 basis points. But I think the more important thing now is that the bond market and everyone's going to realize that if labor data really starts to get weaker, I mean, here's how crazy the Fed was talking before. They used to say, well, if there's a job loss recession, we might not cut rates. And all that stuff is over with. The whole paradigm has now changed. And we want to make sure to get the soft landing. We want to make sure the 10-year yield goes down, as mortgage rates go down. Let's find ways to get the spreads better. Because the one sector of the economy, and they talked about it, that home sales, they're not crashing anymore, but they're not growing. And that was a part of the mortgage rates getting 8%, which did not need to occur. So I cannot ask for a better, like, not only the Fed statements, but the plots, and also the Q&As were good. The Q&As, I always try to like read Powell, his body language and everything, and he's just like, hey, yeah, everything shifted. It was such a positive question and answer. Talk about dual mandates, talking about, the key line for me was that we were really restrictive. Like, we were in really restrictive territory. That's all I needed to hear, because to me, they were in really, I mean, we're doing podcast after podcast off the head. They're really restrictive right now. What are they doing? And they just got better.
So think about, our friends that are mortgage loan officers, they're real estate agents. They are sitting out there. They needed this. We needed this win, right? We need these rates to go down. What does that actually look like? What does that look like in December? What does that look like in January? What does that
Well,
look
first of
like
all,
even farther out?
we should get a second price cut rate change today, and we should be under 7%. So I think now we just focus on the economic data, the labor data. Any weakness now is going to be pushing yields lower, right? There's no more because they're restrictive right now. That's the case. Now I still have my Gandalf line on the 10-year yield at 3.37. We're still far from that, but we almost broke under 4 today. So we're back. We're back in that. We could get some growth again. And the last 5 weeks, purchase application data has been positive, right? We've had 4 positive prints, a flat, and then today we actually came in positive again. So we're growing again. So there's a similar backdrop right now to what we saw last year, right? But last year there was market stress. Last year people thought the U.S. was going to recession because the world markets were going crazy. The dollar was super strong. Now it's different. The rate hike cycle's over with. Next move lower. Any kind of weakness in economic data, 10-year yield goes slower, right? So we still work off of that. But the worst, God, the getting from getting to 8% was so pointless. But it may be a blessing in disguise that actually finally woke the Fed up. Because if you looked at some of the presidents, they were like, "What's going on here? Why are 10-year yields going up? Why? Yeah, you shouldn't talk hawkish." So maybe that was in the backdrop of let's go dovish, give Logan what he wants, give him the Christmas present, and then let's push this forward now in a more positive way. And again, we look at every economic data every day, every week. We track forward-looking data. But right now, there's a lot of similarities to what we're seeing now to what we saw last year, except the backdrop is much different. The rate hike cycle is over. And if the Fed, in a sense, pivots saying we need to be, instead of neutral or restrictive, we need to be more proactive. That to me is what the Fed pivot is. Proactive, 10-year yield goes down. Guess what? Sales are working from a low level. We can get sales up again. So positive day for housing, positive day for the United States of America. A very, very troubling, horrible day for the bearish American Klansmen out there who are just hoping that everyone loses their job because they hate the Fed.
Absolutely. Okay, so this time last year we had those positive purchase application weeks because we were in the, I think, 5.99% area. And so we're under 7 now. You're saying, are we going to get into the fives in the near future?
We definitely need to see softer data, but I think what happened last year, rates went from 7.37% to 5.99%. What that did is it gave us 12 weeks of positive purchase trend application data, right about this time last year as well. Now we've gone from 8% to we're going to be under 7%. And I know a lot of people are getting lower rates than that right now. That's good for the builders. That's good for the existing home sales market. But imagine if we could get there and stay there now and no more Fed hiking rates or talking hawkish or anything like that. That's all over. So I would say the backdrop is different. It happened a little bit later now, but if we keep this trend going, God, if we could get another 12 weeks of positive purchase application data going into the spring season, because it looks out 30 to 90 days, that's as good as you can get, considering it wasn't that long ago. People had 8% mortgage rates, everything, So a little bit of life, something good for the holidays. I think that's the positive theme out there.
So you said we'd have to see softening in other places to get into the fives and with any duration.
With any duration, to me, the Gandalf line becomes very interesting now that the Fed rate hike cycle is done. But we are so far from 3.37% right now in the 10-year yield that economic data getting weaker actually will flow more money to the bond market, because now the bond market knows the Fed's got its back. I think another thing where the Fed could actually be beneficial, if it wants to be, I don't think they're going to do that anytime soon, talking about no more quantitative tightening or a slowdown of quantitative tightening. We want yields to go down. They're very, very aware of what happened in the housing market with 8% rates. So that's a good thing in a sense, and we will try to see how the bond market reacts now to economic data. But again, take the victory. We're not at 8% anymore. We're under 7%. Positive purchase application data is growing. Keep that going. We get long-term yields to come down even more, be positive for the U.S. economy, because the one sector that is still at great financial recession levels is the existing home sales market.
All right, so we are at the end of 2023, looking, like you said, 2024, the spring home buying season could be so much better than last year, especially if we get these, these many weeks of purchase application data that's positive. Where do you think seasonality is gonna head next year? Last year was so difficult. We had weird January, February numbers. It pushed back the whole year. What do you think we're gonna see
See,
this year?
here's the thing. Here's the thing with seasonality and inventory. I have a working theory here that we have had very abnormal housing inventory, seasonal inventory patterns. Everybody has their own take on it. I have this. Usually, what happens is purchase application data after the second week of January rises kind of toward the first week of May. After May, volumes fall. What's occurred at the end of 2020 is that there was the makeup demand from COVID, right? We just had a few months, nobody was doing anything. So we just make it up. Forward looking positive, because I'm not a mortgage rate lockdown person. Mortgage rates going lower, demand picking up can delay the growth of inventory or bring it down. So inventory, the bottom that usually happens in January, maybe February at sometimes, was happening later on, March and April. Then in 2021, going into 2022, extremely abnormal. We had volume increases in purchase apps. Never happens that time of the year. Pushed out inventory, seasonal bottom to March. Very abnormal. Then last year at this time, the 10-year yield peaked at 4.25, market stressed, bond yields came down, 12 weeks of positive purchase application data. We had that very big existing home sales print from 4 million to 4.5 million. It took to April 14th to find the seasonal bottom. So it's going to be really interesting now to take a look at the first 6 to 7 weeks of the weekly inventory, which we have here at HousingWire, and see if this is the case now. Because guess what's happening? Mortgage rates are falling again. Demand is picking up. This data line, the purchase apps look out 30 to 90 days. So you don't necessarily fill out an application, buy a home that afternoon and get it recorded. So it takes some time to filter through the sales data, which means it takes time to go into the inventory data. We're in the seasonal decline of inventory, working at from very low levels. So you could see what happens is that the seasonal inventory bottom happens later. And in some cases, the seasonal peak happens a little bit later as well. But that'll be very interesting because we have that dynamic once again. We're saying that we're thinking, is this going to happen again? This will be the fourth year, so we really have to keep a track of the weekly tracker data on the active listings and new listing side.
It has been so unusual in many respects, but that late in the year, bump up in people buying homes, and then what that does to the spring selling season has been awful. When you think about inventory, we know inventory is not good. With rates coming down, I know you're not a mortgage rate lockdown person, but isn't it true that some people will feel better about listing their homes because then they're going to feel better about buying a home with lower rates?
Rates go down, demand picks up. You have more people selling their homes to be buyers. When we talk about active inventory, we're talking about, and this is a good way to explain it. When you list your house, you find a buyer, you sell that house, you buy another house in the process. You don't necessarily stay on the active inventory side because the transactions go faster. What also occurs, and this is really the key thing, who provides no inventory when they buy a house? It's a first-time home buyer. So a first-time home buyer, millennial, Gen Z, finance 93% plus of their homes with mortgages. So when rates come down, they're taking something off and not giving you anything. So when we look at inventory going back to 2013, when demand starts to pick up, actually 2014 was a year where demand actually fell. Inventory has been slowly falling. Purchase application data has been slowly rising since then. Millennials started buying in 2013. They're not giving you inventory. So you can see what happens when rates go lower. Inventory falls, stays flat, or inventory falls. When it goes higher, you have some period of times where inventory can go up because things take a little bit longer to sell. So again, this is a first world problem to have at this point, that demand picks up from these very low levels. But that could be an issue next year if this is the case, that we don't have the inventory growth that some people would want to see, especially like myself. But again, this is why we track the data. Housing has been so stuck at these historical low levels in demand. We're missing about 4.2 to 4.7 million home buyers that would be part of the mix. So it's in all branches. It's not just first time home buyers, move up buyers, move down buyers, cash buyers, investors. So we'll cross that bridge on the inventory side when it comes up there. This is why the tracker is going to be very key, especially going out for the next 12 to 14 weeks. But again, it wasn't that long ago that we're talking about 8% mortgage rates. That, can the builders actually pay down enough to move product? Our home sales going to be stuck here. And since rates started to fall, the forward-looking data has been positive, similar to last year. We go with that every single week. I'll update everyone. I'll keep everyone in tune, but this is why we do live tracking data. We do not sit with yearly forecasts. They are useless in this kind of environment. In the past decade, it was a little bit easier because things move so slow. You can't do it now anymore. It is an inefficient human being looking at yearly forecasts in this sense. You got to go with live data, because when something changes, you got to be there for it, right? Last year, when we talk about, Sarah, I just did a podcast with downtown Josh Brown, Wall Street, and I was saying, do you know how hard it is to convince people that the market changed on November 9th and that the forward-looking data is getting better, and you got to go with it. If you don't go with it, you're going to be lost. And now I think there's some realization that, hey, if this happens again, do we really want to be really bearish on everything? I mean, the forward-looking data gets better. If the forward-looking data gets better for 12 to 18 months, oh my. You don't want to be that old and slow. We don't want to be that old and slow. So we'll track the weeklies. We'll keep everyone updated. But my Lord Almighty, we got a Christmas gift. The Fed brought out the doves, and that's all we should focus about today. And then we'll just take off the economic data every single day off of that and just go with it. But a victory for sure.
A victory. Logan, thank you so much for being on and really closing this chapter for us. As you said, it's over, it's the end, and even Powell said it's over. So we're excited about that.
And for some of my friends that were messaging me, because we always say the Dallas, the Minnesota Fed and the San Francisco Fed staffers listen to this. I know, no, this is nothing. This is the Fed. They did this all on their own, right? They corrected a mistake they made a few months ago. Just thinking about that, and let's move forward. Keep the economy going. No job loss recessions. Let's see if we can get a soft landing. Let's get a good Christmas going on here.
I love it. I'm for it. Thank you, Logan.
Thank you, Sarah.